Welcome to Money Maximized. Today our video is about understanding risk and reward in investing. Understanding risk and reward is crucial when it comes to investing. It involves evaluating the potential gains and losses associated with different investment opportunities. Here's a breakdown of risk and reward in investing. Risk in the context of investing. Risk refers to the probability of losing money or not achieving the expected returns on an investment. All investments carry some level of risk, and it's essential for investors to assess and manage these risks effectively. Some key points about risk in investing include types of risk. There are various types of risks investors should be aware of, including market risk, fluctuations in the overall market, credit risk, the risk of borrower default, liquidity risk, difficulty in selling an investment quickly without significant loss, and specific risks related to individual assets or industries. Risk tolerance. Every investor has a unique risk tolerance, which is the level of risk they are comfortable with. It depends on factors such as age, financial goals, investment experience, and emotional temperament. Diversification. Diversifying your investment portfolio is a common risk management strategy. By spreading your investments across different asset classes and industries, you can potentially reduce the impact of any single investment's poor performance on your overall portfolio. Research and due diligence. Conducting thorough research before investing is essential. Understanding the underlying assets, market conditions, and potential risks associated with an investment can help you make more informed decisions. Reward. The reward in investing is the potential return or profit an investor can earn on their investment. Higher risk investments typically offer the potential for higher returns, while lower risk investments generally provide more modest returns. Some key points about rewards in investing include return on investment, ROI. ROI is the percentage gain or loss on an investment relative to its cost. It's a measure of the investment's profitability. Time horizon. The time horizon of your investment plays a significant role in determining the potential reward. Generally, investments with longer time horizons may offer higher returns due to the power of compounding. Asset allocation. Allocating your investment funds across different asset classes can impact the potential reward. Riskier assets like stocks may have higher potential returns compared to safer assets like bonds. Investment goals. Different investment goals may require different levels of reward. For example, retirement savings may require steady, sustainable returns, while saving for a shorter-term goal may involve seeking higher returns through riskier investments. Past performance versus future performance. Past performance does not guarantee future results. While historical data can provide insights, it's essential to consider the current economic and market conditions when evaluating potential rewards. In summary, understanding the relationship between risk and reward is fundamental to making informed investment decisions. Balancing your risk tolerance with your investment goals and conducting proper research will help you navigate the complexities of investing and work towards achieving your financial objectives. Thanks for watching. Please don't forget to like, share, and subscribe.